My biggest beef with pumpkin brews is it's like somebody just takes like a dash of pumpkin and calls it pumpkin. I'm like, man, I want to taste pie.
Right.
So there's a little skit for you guys.
Yeah.
I want to taste pie.
We know you like pie. I'm gonna run it back and tell you how much I like pie.
Yeah, I like this, man. I'm maybe 4.25.
What's that ABV?
5.6, I believe. Yeah, 4.25, man. I'm gonna stick with that.
Yeah.
Nice pumpkin brew though.
What other kind of pie do you like?
We're gonna throw it over the tolls.
Hops and Stocks podcast is presented by 100 Spoke Media Group. We encourage our listeners to drink responsibly. Please note, we are not financial advisors. We do not offer or provide financial advice.
I'm Spoke affiliated from the city of Jim.
Welcome back to the Hops and Stocks podcast, brought to you by 100 Spoke Media Group. This is episode 53. We got our man Ross Wright.
There he is.
He's joining us for the second time. Ross is going to talk options with us. But before we get into the beer and the options talk, how's everybody been doing this week, man?
Hey,
good, man.
Pretty good.
All love,
weather's been great. Weather's been cool in the morning and perfect weather. So I'm good.
Yeah, windows up type weather.
Absolutely, man.
Yeah, AC off, giving the AC a break.
Absolutely. I'm really trying to beat the system now with the solar because I ain't got nothing running but some lights. And I'm killing it. So I can't wait to get my next Duke Energy bill.
Yeah, you're trying to get paid.
How much y'all owe me this month?
How much y'all owe me this month? Episode 54, we bring it back Ross to talk about solar energy.
Hey, we'll talk about that. That's one that I really get into as well. But no, I'm happy to be here, man. I enjoy this brotherly fellowship and the fact that we can get, 5 of us African-American men to talk about like these sorts of topics. And I do see other topics. I don't get to watch all of them, but I've checked out some of the other topics of other guests. And the fact that you have this energy and the sharing of information is so important because we all learning. I'm learning from you guys. Hopefully, you guys are learning from me, and then whoever's watching this, maybe they're learning as well. And we all uplift the community by doing it, which I think is just awesome. This is the kind of stuff that we need to portray, and so this is great. I'm glad to be back.
Appreciate you, man.
Sounds good.
Everybody else good?
Yeah, awesome. Ross, you a UC Law grad or?
Yes, sir. Actually, what was funny, I was kind of getting a chuckle out of the UC Law School just spent a whole bunch of money and they opened up a new facility.
Yeah, I was there. I was at the opening yesterday.
Were you? And this, what I did not know is that it's right. They kind of re-imaged Lindner.
Yeah, it's the old business school.
Exactly. So that's where what was funny is that I came out of Lindner in '90 with a business degree. And then went across campus and went to the law degree. And then I saw the pictures. I was like, shit, that's Lindner. And it was like, oh no, that's the law school now. They just re-imaged Lindner. So
you wouldn't recognize
like it was
none
nice.
of that. You wouldn't recognize it inside.
I saw the pictures. I was like, man, especially the inside. I mean, it looked really state of the art. Did you go? Did you actually go to the?
Yeah.
How was it?
It was nice, man. They really did it big. They had one of the justices from the Ohio Supreme Court.
I saw that.
Kind of do the welcome or whatever. It was nice.
A real good thing from the dean, African American
dean. Yeah, she's stepping down.
Yeah, she took a gig in I forget the name of the organization, but I think it's in DC or something. And what I did not know, because I contribute to the Ohio Policy and Justice, that group. I didn't know that her husband. I didn't know her husband was the head of that, David Singleton. I never made that connection, and then somehow, some way, I read something that said that Verna was the wife of David, and I think it was from Ohio Policy and Justice to people who donate and said, hey, he's not leaving now, but he might be leaving. But I mean, they do a lot of good in the community. Both of them, her to the law school and him to the Ohio Justice thing. So they do some really, really good work.
Yeah,
really good work. Really good work. So I don't know how y'all want to start this out, man. I'm just figured this would be just open kimono and we can just kind of roll through this. Or how do you guys want to do it?
we got an order of business we got to take care of first.
Yeah.
Go ahead, brothers.
So, like we always do about this time, and I'm like, I ain't even energized to kick it over to this guy, man. You know what I'm saying?
Man, show him some love, man.
I can't, man. Like it hurts my heart to show him love right now, man.
Let me kick it over to him.
You
man.
kick it over to him, man.
I'm gonna throw it over.
Somebody better kick it to me, man.
I got you, B-Dub. I'm gonna throw it over to the man with the plan. Mr. What's in this can? What we sipping on tonight?
Thank you, Blast.
Dog-ish.
So let's talk about it, man.
No, just
Today's review is coming from Shipyard Brewing Company. It's out of Portland, Maine. It's called Smash Pumpkin. Almost didn't buy this because I was thinking it had like a from the looks of it, Smash Pumpkin. I was thinking puree-ish.
Yeah.
So I was like, maybe I'll skip on this one. But as soon as I seen that ABV, I'm like, all right, let me give it a try. It's coming in at 9.
Ooh.
20 on the IBUs. It's a pumpkin yam beer.
I've heard of those. I don't really know what it is, but I have heard of the yam.
Never heard of a yam beer.
He jumped off. He looks like he has some insight.
Yeah.
Nah, I don't. I honestly, my fault, beat up. I just have never found a pumpkin beer that I like, and
I know you feel that way. Yeah, I got a pumpkin one too. So we're gonna hopefully me and B-Dub will get some quality ones here.
Yeah.
So I'm thinking this is more actual pumpkin than it is flavoring pumpkin. Okay. So that's the reason why I chose it. But it has notes of cinnamon, burnt sugar, and obviously pumpkin.
I surely like the color coordinations on that. That's some Houday colors right there.
Yeah, I like the color of the beer too.
Yeah, the beer look good.
I like pumpkin a lot, but I'll have to write these two down because I may have to go out and peek these because I like my pumpkin.
You like it? He likes it.
I look like a such review coming, man.
Yeah, I can't tell. I can't tell.
I had my thoughts ready to go ahead and dog walk this beer, but it's not bad.
Oh, okay.
And I'm not a big fan of pumpkin, but that's love right there, man. It's got a bitterness towards the end, but it's sweet. I'm not a fan of pumpkin, but this is good, man. This is a 4 at least.
Yeah, I was gonna say that sounds like 4.5 talk.
Ale.
It's an ale. And this is one of the more insightful cans I've ever seen. Like on the back of it even tells you what pairs with it.
Oh, damn.
Wow.
What does it pair with?
It just has pictures. Even had football, candy, which I love.
Yeah, those are two of your favorites, man.
Even has the hops and the wheat. It's a pale whole wheat unit, and it's a Willamette Sapphire hop. But yeah, this is a well thought out can.
Where's Shipyard from?
Portland,
man.
Okay, yeah, that makes sense.
This is love, man. I'm gonna go ahead and go up to a 4.25 on this one, man.
So you mentioned like burnt sugar and cinnamon. Are you getting those notes on it?
Yeah, that's that sweetness I'm tasting right there. That's probably why I like it, because it's sweet. It's not overly sweet though.
Yeah.
So that overly sweet, it gets you. You can only drink one, you get sick after a while. But this one's legit. This is a good seasonal beer right here. Good color to it. Yeah. Shipyard Smash Pumpkin. I recommend that. 4.25.
Got you. Anything in that glass should taste like trash.
Right.
Yeah.
It should start with a 2 in the front.
Right. He's so brand oriented, man. This guy, man.
The hate is coming out of nowhere.
I'm saying
nothing about Ohio State, man.
I haven't said nothing about your team. I said something about that specific shirt.
It's my team.
Man, no, it's the state. It's entire.
It's about my team, though.
Man, let him.
All right, let's reel it back. Blast, you going next?
Shipyard Brewing, Portland, Maine. Smash Pumpkin, 4.25.
Right there. I like
we starting off better than last. Was last week the week we had all duds, or was that the week before?
Nah, that was the week before. Should I Well, shoot,
He had a 5.
I had a 5 last week. Beat up. I got one I want to try too. Yeah, last week was all sours, but I had a 5, man.
A 5 sour?
A 5 sour. It really wasn't sour, bro. It was super sweet.
All right, man. I'm gonna kick it off if you guys.
Hold on, man. You can't.
I already kicked it to
my number 2 spot.
Oh, okay. I mean, well, we got an order. All right.
Thanks, beat up. I'm sticking with the pumpkin theme tonight. I'm taking it back to Third Eye, located by the homie Doug out in Sharonville.
Yeah.
Okay.
They like spelling things with that EYE, so this is called Pumpkin Pie, PEYE. It's a pumpkin spice ale, 5.6% ABV. A little backstory, it says this dessert-inspired beer features Colonel D's pumpkin pie spice blend. Colonel D is a cat, I think he recently passed, but he owned a spice business down in Findlay Market. So I had a couple of pumpkins I was going to try, and somebody was like, why don't you do this one because it's got the local tie. But it's got a sweet vanilla, real graham cracker, and it's best enjoyed while watching a scary movie in your favorite sweater. I should have rocked the sweater. And maybe watch some Jace.
That's my favorite time.
Deeper brown too. A little deeper brown color.
That's probably one of them joints I wouldn't like.
No, right. This is right. This is right. And you would like this. I think you would like it because it ain't overly sweet, but it does have enough to where you're drinking something pumpkin pie based. Like my biggest beef with pumpkin brews is it's like somebody just takes like a dash of pumpkin and calls it pumpkin. I'm like, man, I want to taste pie.
Right.
So, yeah, there's a little skit for you guys.
Yeah.
I want to taste pie.
We know you like pie.
I'm gonna run it back and tell you how much I like pie.
Yeah, I like this, man. I'm maybe 4.25.
What's that ABV?
5.6, I believe. Yeah, 4.25, man. I'm gonna stick with that. Yeah. Nice pumpkin brew though.
What other kind of pie do you like?
We're gonna throw it over the tolls.
Hey, man. I'm going with this evening a Brink. I'm not sure if I've done this one already or if anyone's done it, but it's
I don't
a Brink.
think so. I think we only did one Brink.
I'm anxious to see that color on that one, man.
Right. It's a Damocles black milkshake IPA.
You take your glasses off, man.
Out of Cincinnati, Ohio. I'm not taking the glasses off today, man. y'all know what I'm on, man. I'm only on 8 ounces. So
okay.
That's the 8 ounce pour.
Beat up doesn't know the backstory.
Yeah, he don't know the backstory.
He don't need to know, man. Let's taste this.
That's a good looking brew though.
That's righteous.
It looked like a stout.
Yeah.
It's a black milkshake IPA. That's what I said. A little bitter for my liking, but
yeah, it's not righteous.
It's 6.8. No, it's not righteous. I like to give it a real, it's bitter on the back end. I like it on the front end. It smells the notes. It's a nice nose if I can get it from down low. But the bitterness, I'm not really feeling the bitterness. I'll give this 4. Like right now, as it's settling on my tongue, I still getting the bitterness. I don't like that. Like when after go
ahead, say it.
After it goes down.
He was in dangerous territory, settling on the tongue.
After it goes down, I want it gone. I don't want to have a lingering aftertaste at all. But this is giving you an aftertaste.
After you take it down, you don't.
But I'm gonna drink the 8 ounces.
I'm sorry, guys. Sorry.
I'm gonna drink the 8 ounces.
You gonna take on 8?
Yeah. Oh wow,
8 ounces.
Wow.
He said once he takes his date, he wants it gone.
Oh my goodness, man! What are we doing?
All right, man. I'm gonna pick up.
Let's reel this fish back in.
Reel this back in, man.
Again, Cincinnati, Ohio, Brink Brewing. You did a pretty good job. You did a 4. I mean, you got to be happy with a 4.
Yeah, 4 is solid, man.
Quality beer. The aftertaste, I'm not feeling, and the bitterness won't go away. What you got? Ross? Oh no, it's E. Go ahead.
You know what? I didn't. I forgot to get my brew, man. I'm just sitting here
Okay.
drinking the sparkling water, so I'll pass to E.
Okay.
Let E take over. But I didn't took some notes. I think I'm gonna cop one of these pumpkin ones for sure.
Yeah.
All right. I'm gonna close out this review section, man. Got my trusty Yeti still.
Yeah, man. Sponsored by.
Yeti sponsored us. So what I got here,
Great can.
1911.
That's a good year.
Great year.
This is by Beak and Skiff. Where is Beak and Skiff out of?
Saw that today on the show, man. Not that particular one, but that brew house.
Where they out of?
Yeah, you know what? I think I have seen that now that you mention it.
Yeah, I'll get back to where they out of, but handcrafted in New York. So this is I went with a premium hard cider, and like B-Dub said, dope can work, and I literally bought this just for the can work. It stood out on the shelf. It was on the top shelf of the brews, and I couldn't walk past it. I was like, damn, that's a dope can work.
Creative. Yeah.
Yeah, so I picked it up. It's a cherry hard cider. This mug actually has a sweetness scale on the back. Probably to zoom in to kind of see it. And on the sweetness scale, they rate it from 1 to 6. This is a 4. It says lights up the night with electrifyingly crisp and slightly tart flavor of 1911 black cherry hard cider. Let me crack the joint real quick.
I'm a fan of hard ciders, man. Nice color.
Yeah, it looks good.
Yeah, you got a nice, I don't know, kind of peachy type color.
Yeah.
Clear.
It looked light and crisp.
Nah, it has that first little tart note. I was drinking these tailgating this past weekend. I really do like this. You get the cherry, but weirdly enough, you get like Granny Smith apples. Like there's a taste of Granny Smith apples mixed with cherry. They don't define apple as one of the notes, but that's kind of how it tastes. Once again, it looks like it tastes. I mean, it's really, really light, really, really crisp. It's a tad on the end of my spectrum for sweetness. That would be the only knock. But I bought a 4-pack of this. I think it was like $13.99 or something like that. But it's nailing all the notes. You're getting cherry, that black cherry. It's not overly tart. Borderline a little too sweet for me, but I ain't gonna knock it, man. Because like I said, based upon they scale, it's 4 out of 6. I'm gonna get this joint 4.5, man. I like it a lot. I would cop it again. It probably has a 2-can maximum. Like I will only probably drink like 2 and be done, but it's a good looking brew, man. It tastes good.
Looks good.
I think I'm gonna go up to a 4.5, man.
I think I'm there too, B-Dub.
Well, you guys, I mean, this go around, you guys, all the beers seem to be much higher than last time I was on the show, because there was a couple of them I know that was like, man, it was severe thumbs down. So this is
So I just noticed something on this can. It says Beak and Skiff Apple Orchards. So I wonder if they put apple in here, because I'm definitely getting an apple note.
Okay.
Gotcha.
And they got a lot of information on the back of the can. Like I said, it's like 3 paragraphs on the back of the joint.
Damn.
Obviously, I don't got time.
It's like a couple Bible verses on there.
Yeah, I'm gonna do some more. I'm gonna read this. I ain't gonna read it on the pod, but I'll put a little blurb on the IG page about this, man. Once again, this really good, man. 6.9 on the ABV, so it's got a little punch to it.
I'd like to know why they chose 1911. Maybe there's something on the description. I mean, you don't have to skim and scan now, but
yeah, I'll get back to you, Doug. I'll post something about it.
Yeah.
Hey, Blast, is yours yam beer too, or is it just straight pumpkin?
They didn't mention anything about that. It just, says pumpkin spice ale.
This one says pumpkin, yam, or winter squash.
Okay, yeah. I don't got the yam note.
Definitely
It's good though,
Get
man.
one-
I would
one of
definitely get
pumpkins.
this.
Definitely
Yeah, I'll get one.
ordering on
For
some
sure.
a dessert ale.
Did you pour some more? Because
Yeah.
I thought I could have sworn that mug was down there somewhere.
When I pour a beer, it's usually too much for this Pilsner glass. So I got to take it down and fill it back up again.
Got it. Once again, we want to welcome back our guy, Ross Wright. I reached out to Ross a couple weeks ago. I follow Ross on Facebook, man. And Ross, you're an interesting cat, man.
I'm crazy, man.
Seriously, man, you're an interesting follow, man. You're a jack of all trades. You touch on a lot of information, but you have made a post about making some option plays. And options is something that I know all of us are interested in, but I don't believe any of us are dabbling in option trades currently. If I'm wrong, correct me. So reached out to you, looking for you to guide us and give us some nuggets on how to jump into that world of option trading, man. Like I said, it seems like that's a play that can, get you some returns relatively quickly.
Yeah. And hey, I appreciate this. And again, it's not like investment advice or anything like that. Really, what I'm going to do is I'm going to share some of my own screenshots from some of my trading. And then that's the best way. Just use myself as an example, show you like what I have in play for options like right now. I'm going to do that like in the call. But before I do that, just real quickly, obviously this is not advice, but it's just a conversation for us to just kind of share and get to learn information. And when I think about investing, even before we talk about options, I always think about just having strategies. And I personally have like a lot of buckets in my head or folders in my head of how I like to approach investing. So probably about 90+% of everything is in what I would call, and I'm going to start sharing a little bit, is just kind of traditional assets. It's, this stuff. And this is just it's a 401k, and just let me know when you can see it. So this is just an example of like what I would say is like my 90+% play. So this strategy is long-term capital growth and appreciation and some dividends. And as you can see over here, it's just kind of your bellwether companies. In this particular position, which is one of the largest holdings I have, the top 10 is Microsoft, Apple, Amazon, Alphabet, ConocoPhillips, Johnson & Johnson, United Health Group, MasterCard, Qualcomm, Merck. And this is 33%. And there's a whole bunch of there's like Home Depot, Lowe's, everybody that you can think of. And so, option trading obviously is a lot more kind of short-term focus, but just to sort of lay the groundwork for me in terms of long-term retirement, I would say 90+% of my stuff, because sometimes people I think see stuff that I may post is like, man, this dude's got all his money in Bitcoin or silver or solar panels or whatever. It's like, no, most of my stuff is in what I would think most people would have their stuff in, which is these kinds of positions. And then at the opposite end of the spectrum, if you will, there is what I think I don't see Bitcoin myself as being speculative, but this is a screenshot of my Coinbase account. So most of my, I believe it's future growth, but some people call it speculation. Bitcoin is like my number one. So 80% of my crypto is in Bitcoin. And then I got Litecoin, Ethereum Classic, and a whole bunch of other ones, because I really do believe that kind of the future of money and transactions is in this space. But when I consider this play, this strategy, kind of the future growth versus what I talked about with my sort of retirement like stuff, it's just a completely different ball game. I'm trying to pull up another screen. This is what I call, I have these goofy names. So when I call for
if I could stop you for just a second.
Yes, sir.
I want to point out that on your option summary screen, it looks like you're going by the name of Ross Black Magic Wright.
Yes.
Baby Yoda.
Yes.
Money.
Absolutely.
That's quite.
And that's with intent. Well, so what's funny is like when I call Fidelity and the person has to actually address me, like they have the same reaction. Like, who the hell is this guy? I call you Ross. I call you. I was like, look, you can call me whatever you want. I just got a couple questions for you. But I have these crazy names. So this is my option summary thing. But this one is like another one called Black Magic Future Society. So these are like more speculative, kind of like a Bitcoin. Because in this I have stuff like I got cannabis stock. I'm trying to figure out if I can get these damn screens to work. Let me just pull this one away. See if I can get to the one I'm trying to get to. Well, I'm not getting to anything right now. Let me see, where is this one? No, it's not it. but you know, so yeah, there's a big difference between what I'm trying to make as an opening statement. There's a big difference between like the retirement type stuff, which is where I have most of my, you know, money. And I would recommend that people put most of their money there. And then their future growth, which is kind of Bitcoin and cannabis and EVs and all this kind of futuristic stuff. And then I have my day trading account. And what I'm sharing here on this screen is like what I currently have in terms of, if I can get this to blow up, like what I have right now, just like as of today in terms of options. And this stuff can change all of the time. So I got Ford, I got GE, I got a electric car company called Canoe. I got Kohl's. I got a lithium ion battery company called LIT. I think that's actually an exchange traded fund. So it's a combination of battery makers. Marvel Technologies, not the movie Marvel, and then PNC. And what you can see here, and I'm going to run through kind of a quick definition, is for me, because options to me really fundamentally is a contract or an agreement between two people to facilitate a future transaction on an underlying security or asset at a preset price, and that's referred to as a strike price, prior to an expiration date. So essentially, just put this stuff aside and think about like if I was, or you were trying to buy a house from me, and you say, hey, you know what, I don't know if I really want to buy this thing, but I tell you what, I'll pay you for a $50,000 asset. Just I'm gonna make this up, a house. I'll pay you, Ross, $500 to hold this open for 90 days. And you lock me in and say, contractually, you can't sell this to anybody else. You're gonna collect money from me, $500, and it's gonna be locked in for 90 days. And let's say that for whatever reason in that 90 days, the value of that house by legitimate appraisers goes up to like $90,000. Well, you have a contractual right to buy at 50. So you could either exercise what would, in this instance, what we call a call option, a right to purchase. You could exercise your option against me, irrespective of the fact I could be pissed, like, damn, I can't believe my property is now worth 90 grand. I agreed to sell it to this dude and hold it open for 90 days. He gave me $500, but I got to sell it to him at 50 grand. So you could buy the damn house at the 50 grand because you got that contractual right. You paid me $500. You buy it for 50, you turn around and sell it for 90, you make $40,000 minus the $500 premium you paid me to do the house. And you're good in the money. However, with options, usually what happens is the person, myself in this screen, I'm not necessarily interested in owning the actual asset or security, because the option itself, the option inherently itself actually has value that will exceed that $500. So in other words, using that example, you give me $500 and I say, I'll sell you this house for 50 grand. The house goes up to $90,000. Anybody in the marketplace knows that, hey, Doug Toller or Eric or William or B-Dub has a right, a contractual right. And this is what options trading does. You know that people have this right to actually purchase it at $50,000. And then they say, hey, Eric, how much did you pay Ross for that option? Well, I had to call for $500 for the option, but here it is. I got the contract. He's got to honor this contract. I mean, that's what an option contract does. And then the guy says, you know what, Eric, I tell you what, how about I give you $4,000 for that option, just that piece of paper. And then you say, well, shit, yeah, I'll tell you, I really didn't want the damn house anyway. All I wanted was to make me a little money. So I tell you what, person X, you give me $4,000, I will gladly sell you this right to purchase this asset that I have, that I only bought for $500. So then you sell it to this other person in the marketplace. They give you $4 grand, you plus $3,500 in the good. And then they go and buy, maybe they buy the house, or hell, maybe they sell it to somebody else. Who the hell knows? But the idea of an option. So, and I have, I actually had and you guys may be familiar with this, but I wanted to do, I had a real short screen share. If you guys don't mind, I was going to play this. I thought it's only like a minute and a half. So let's just listen to this real quick. It gives the example in the stock market.
A share, also
Wrong
called a
one.
stock,
My
is a
bad.
unit of
My
ownership in a
bad.
corporation
That's not
or
the one.
financial
That's not the
asset.
one.
Owning some.
Got another one. It's the option one. My bad.
Hey, Ross, real quick, while you trying to bring up the video.
Yes, sir.
So that option
Yes, sir.
can change hands multiple times before. So just say you collected that 4,000. That person that bought it for 4,000, he can turn around and sell it for 8,000. Somebody can buy it for that 8, and then they can turn around and keep just selling it, selling, selling it.
It's a hot potato up until the expiration date.
Okay.
So in other words, the expiration date is when the party is over. So if you were to, and I'm going to walk through the example on my screen, I'm going to actually walk through the dates on my act, like what I'm under, like what I have in play right now with the dates. And what you'll see from those dates is that's the time that I have for this. And it's not a house, obviously, but I think the house example is a lot more sort of understandable than to get caught up in the stock. But we're going to go back to the stock, but the principle is the same. What you're going to see on my screen, the other thing I didn't mention about the option that makes it a powerful tool is that think about if you didn't have an option and you had to buy the damn house, $50,000. You got to fuck up 50. It may go to 90. You know what I'm saying? But you got to put up the whole damn $50,000 and cross your fingers that it goes to 90. With an option contract, you're paying only a fraction of the $50,000. So with $500 in my example, and you'll see the examples in some of the stock trades that I got going on, for a small fraction of the actual cost of the stock, I'm in control of 100 shares. Because when you buy option, they're in lots of 100 shares. So when you buy one option, you'll see on my screen, it equals 100 shares. So from a market value perspective, like one of my have is like with PNC. The one share is trading for over $100 a trade. So you take, $150 times 100 shares. You're talking about like 15. That's $15,000 that you would have to cough up. On my option screen, you'll see what I do with the options is there is and we'll go into this. You'll see this in this video. You can reduce or bound or put a boundary around your risk, because what I do is I will purchase the right to buy, using the example of the $50,000 house, but then I will also sell an option to another person at the same time. In this case, it's called a vertical call option. And it will be easier for me to explain it to you when I get to that screen. So just give me just a second. Let me play this, and then I'll go to the screen and give you some empirical examples.
Ross, before you play that.
Yes, sir.
When you put the bid in for the contract, is that a preset price? Does the seller dictate that price, or do you just call out a price and they can say yay or nay?
When you go to and that's a great question, because the other thing is that to do option trading with most trading platforms, I do mine through Fidelity. You actually have to get you have to get like permission to do it. Like they make you fill out like a little form that says, hey, you're signing up to extra risk here with options because these are quick turn transactions. And so you got to be cool with it. So you have to do that. But once you get permission to do it and you go to the option screen, essentially what the marketplace is setting that. And I'll show you that again. When we get to my screen, I'll actually show you how that works. All right.
Okay.
Let's just check this out real quick.
An options contract is an agreement between two parties for a potential transaction of an asset at a specific price and date. Basically, buying an option offers the right, but not the obligation, to purchase or sell a stock. Call options are purchased as a bet on a stock's appreciation, while put options are purchased to profit if the price declines. A single options contract covers 100 shares of the underlying stock. Options are used for hedging or offsetting risk, but can also be used for speculation, high-risk trades with potentially high rewards. That's because typically options cost a fraction of the underlying shares, and options allow an investor to make a bet on a stock without purchasing or selling shares. For example, company ABC trades at $60, and a seller, also known as a call writer, is looking to sell a covered call at $65 with a 1-month expiration. If the share price stays below $65, the options expire worthless, and the call writer keeps the premium and the shares.
Let me stop right there. So what that basically means is, using my house example, let's say you gave me $500 to hold the house open at $50,000 for 90 days. And let's say during the 90 days, it stayed at like $48,000. And it's like, well, if you're an option trader, you just ate $500 for the premium.
Okay.
So you paid me for the premium, but it never hit the price that actually you want the price in a call option. You want the price to actually exceed what your option strike price is. The strike price is the agreed upon price of the option. So using the housing example, if it went, in my example, from 50,000 to 90,000, then that damn option is worth a whole bunch of money because you have a right to buy it at that rate. But in this example that they're saying, the actual price of the asset or the share or the house or whatever it is does not hit the agreed upon price. So as a result, you just basically, you lost $500. But you know what? Losing $500 or $300 or $200, as you'll see in some of my scenarios, it's much, much better than losing, like if you actually bought the damn shares. Because if in this example, if it was $65 per share and there were 100 shares in one lot, you would have forked over $6,500 to actually own the shares. So options allow you to say, I ain't messing around with putting up $6,500. But I'll put a couple $100 in to buy the option to buy it at this price. And if I lose the $200 or $300, I'm cool with that. But I'm not cool with paying for the actual shares of stock. And so options essentially is exactly what it says. It gives you the option to control 100 shares, or if it was you bought two options, that would be 200 shares. But essentially, you're controlling 100 shares of stock by paying a very small amount of money to control that stock for a set period of time. Let's just finish this up.
They can also collect another premium by writing another call. If the price goes higher than $65, it becomes known as in the money, and the buyer can call the shares, purchasing them at $65. The call buyer can also sell the options if they don't want to purchase shares.
So let me just walk through to the point, and if you guys have, I'm going to walk through just my just screen. Let me move this over here. So from this screen here, this is what I just pulled up for today. So and the rationale behind this, most of my writing of options is anticipating that the stock price at some point before the expiration date is going to go higher than what my agreed upon price is. So the companies that are in today, and that could change tomorrow, because as you guys know, the stock market is really going crazy. So it could be one thing, and then tomorrow at 3 o'clock. And I sometimes set up my things for automatic sale because I don't have time to look at the screens like all day. So you can set up an automatic sale, that sell function, so that once it hits a certain price that you're comfortable with and you're going to make a certain profit, you can just have it auto execute the profit. So for right now, from my vantage point, what I've looked at is, first of all, the market has dropped totally. Like yesterday, it dropped, like the bottom fell out of the market. Now, for some people, it's like, oh shit, the bottom fell out, the world's coming to an end. For me, I think that if I believe you have a good company and you got good products and good management, in my opinion, your stock price is going to, over some period of time, rebound. Now, do I want to own shares of stock? So this is Ford, this is GE, this is a company that does electric vehicles called Canoe, this is Kohl's, this is lithium ion, this is Marble Technology, and this is PNC. And as you can see, look at PNC stock price. It's right now it's trading at like—
You're not sharing right now, Ross.
I'm not, my bad. Shit, my bad. I thought I was sharing.
And for our listeners, all amounts are redacted. Everything is blacked out for our listeners. We don't see any amount.
Yes, sir.
Yeah,
Can you guys see
I
now?
want you to see them millies.
I wish, man. Y'all, can y'all see now?
Yeah, we can see.
My bad. My bad. So this is what I got going on, like as of the close of business today. This is just what I've been messing with. And this could change. Like some of these people may not even be on the list tomorrow because something could happen, especially in this market where I would just auto sell something and then I'll start looking at something else. So what I got is Ford, GE, Canoe, Kohl's, lithium ion, Marble Technologies, and PNC. And just to give you an example of what my risk exposure would be if I was like, well, I'm just going to own all these damn companies. Well, first of all, you're dealing with 100 shares of stock for each one of these. So just look at this bottom. PNC right now closed at $162.41. If I decided I'm going to go and buy 100 shares of stock today in PNC, I got to come up with $16,241 to actually buy the 100 shares. But I was like, I don't want to do that. So what I did was I expect that so this is what I was talking about. This is the date. November 18th is my drop dead date. Excuse my language, whatever shit I want to have happen, it needs to happen between today and November 18th of 2022. And then it's like, what did I think was a good strike price for me? So the +1 means that I bought the right to purchase 100 shares of PNC stock at this agreed upon price of 165. Now, right now it's at 162. So what am I betting? What I'm betting is between today and November 18th, it's going to clear the 165 strike price. In other words, I think it might go up to like 173, 174 between now and November. So I just let it sit there. And I have alerts and stuff set up where I know kind of what's going on and anything major is going on. But I had to pay for this, and I don't remember the exact amount, but I think to purchase the call to sell, to buy at 165, I had that part of the transaction was about $550, right? But then I was like, shit, I really don't even want to give up the $550. So what I want to do is I'm going to choose a strike price $10 higher than my price. And then I'm going to write a contract. I'm going to sell something. I don't own PNC at all. So I'm buying the right to purchase 100 shares at 165. And then I simultaneously sold the right to sell it to the market at 175. And what does that do? The reason why you'll see these staggered transactions and all these companies is I'm trying to reduce my out-of-pocket. So in other words, if I had to spend $500 here to purchase the right to buy it at 165, that's good. But guess what? If it don't hit that 165, then I'm eating the whole damn $500. So I say, you know what I'm going to do? I am going to sell. So the -1 means I'm on the hook to sell the PNC stock to another person at 175. And guess what? Somebody paid me a couple $100 to do that. And these transactions, and when you go into the trading screen, or if you do it through a broker, they happen simultaneously, and there's a net amount. So when I did this trade today, it said the right to buy Ross Wright is $500. And I don't remember the exact amount, but I'm just using it. It's a pretty close example. $500 to control $16,500 worth of shares of stock in PNC. I had to put up 500, but I didn't want to put the 500. So I said, I'm going to sell the right I'm going to get $200 from somebody else. And that's going to offset the $500. So in other words, if PNC stock in my head between now and November 18th, let's say it hits about 173, 172, I'm going to probably make, I think it was like $500 or $600 off of that transaction. And you can collectively sell the whole, thing. So in other words, if it got to, let's say it got to 172 tomorrow, I would have a trading thing to sell this one, and I would sell this one back, and I would net out about $500 or $600 off the transaction. Fundamentally, when you think about calls, and there's options, there's all kinds of permutations of it. But at its basic level, there is a call and there is a put. A call gives me the right to purchase a stock at, in PNC's case, at $165, and then for it to happen by November 18th. And so I can wait. I'm just sitting here waiting. There's no way I'm gonna wait till November 18th. It's not gonna happen. But I want to give the market time to make sure that if PNC at the close of business today was at 162, I want to give the market it's November. So it's like you got September. So we got October, and then we got November. In my mind, and this is just a value judgment, based on my reading about PNC and what the investing community has said about where the stock price is going, I'm pretty confident. I'm willing to take that risk. For 300 bills, I'm willing to take the risk to say PNC is going to clear probably 170. I'm going to make my money. I'm going to close this transaction out, and I'll be off to the next thing. And then sometimes what I'll do is, you can do this all day. You can go back to the same company. I've done it with Apple probably in the last 3 months 4 months, 3 different times. Apple stock will go down. Like the market went down yesterday. I don't have it in there because I may do it tomorrow. You got to think about Apple. Like Apple's a good damn company. You got to think that if the whole stock market is down and they're down too, guess what? They're going to come back up.
Yeah, they're coming back up.
So if they're going to come back up, you've got to make a value determination, or your broker's got to make a value determination. When is that actually going to happen? So everything that permeates this whole list is my belief. So the next one is Marvel Technologies. Their stock prices are trading at 48.41 as of close of business today. I bought a call to sell it at 52.50. So that's me plus one, means I had to pay money for that. But then again, my philosophy is I'm trying to offset the cost that I spent. So I will simultaneously, and I typically will spread my differential here by about $10. So I bought and then I sold. So then that made the amount of money that I had to actually come out of pocket to pay for the whole transaction less, because this minus means I sold to somebody else that I would sell them the shares that I have a right to buy at 62. But shit, by the time it's 62, I made a pretty good chunk of money. I made a good profit. If that once that stock price gets up to about 54, 55, I'm going to make money, and then I'm just going to get out of the whole thing. So I'm never going to see this person. I don't plan to see this person who I bought the right. So every one of these you'll see, except for this one. This one I bought a straight call, and I'm probably not going to make anything on this, but it was like I had to spend, I don't know, about $70 to buy the call. So what I did was on this long call, I said, I think this company had just landed an order with Walmart to sell some electric vehicle vans. And I was like, you know what? I think I'm going to buy, this was a couple months ago, I think I'm going to buy a right to buy 100 shares at a strike price of $5. Well, it's not going to happen because it's at $2.60 and it expires this week. But I'm only out $70. I don't care, because I'm going to make, in my opinion, I'm going to make the money off of some of these other trades. And I'm also going to I'm constantly flipping these things out. And so the idea of a option is exactly what it says. It is giving you the option to do something, but you don't have the obligation to do it. And the way you defray the cost of the option, and I'm not trying to be confusing, but the way I have most of these are staggered, because I'm trying to make it so what I have to spend to get my call is offset partially by me simultaneously selling a call. So I will buy a call, and I will write a call. A put is the exact opposite. A put contract is where a person can actually put or force you sign an agreement that says if the stock price drops. Usually when you think about puts, just generically, you're thinking about if the stock price drops. I tell you where I did this. I did it with Best Buy last November. I was like, I think Best Buy over some period of time is going to be really good, but I still don't want to buy their shares right now. So I entered into an agreement with somebody else to say I will buy 100 shares of Best Buy at a predetermined price, but it was my price. I don't remember what the price was at the time, but let's just say it was $131. And I said, I don't want to buy it at $131 because I don't know how much more it's going to rise above $131. I said, but I tell you what, if that bad boy goes down to about 122, what I consider my discount price, I'll agree to purchase the 100 shares at that price because I think that's the right price for it. And so I wrote a contract with another person that gave them the right on a put. They can put those shares to me at their option if it hit that price. And so when the price hit my price, that person decided I'm gonna essentially make you buy these shares. You have to buy these shares of stock, which I was okay with because I wanted to buy the shares. I just didn't want to buy it at the current market price. So when you talk about calls, it's the ability that you have to get a price predetermined for a set period of time. So for Ford, this is Ford. I got Ford. I got options expiring next month, August 21. And the price right now for Ford is $14.66. and my strike price is $16. So I bought one and I sold one to lower the amount of my out-of-pocket costs. GE, same thing. It's trading at 70.03. I have a call option right now that is $70. So I have a right to purchase these shares at $70 per share when the market price is 70.03. But I'm going to wait it out. And that's why I made my expiration date into December, because I think from what I've read in the market, the price is going to go, I don't know, maybe like 76, 77, maybe higher. And then I'll make money off of that. So
Ross, it seems enticing. It seems enticing from the standpoint that you're able to kind of create your own risk management. You know what I mean? Because your differential is always $10, and you're always setting it up where you're not going to be real greedy, but you're not going to take a big loss either. So it seems like the more things you have going on, the more money you can make.
Yeah, if you have, and the key to this is that, so you got to get permission. And then if you decide to do trading, whether to yourself or to another broker, you also would want to, I have like a margin account, and essentially it's like it's a kind of a credit card of just like same as cash for trading. So in other words, I don't usually, I do trade on margin, but I always have the cash in the background to be able to satisfy the transaction. But essentially margin is you're buying a stock on credit, and you can get 2 days worth of float before they knock at the door and say, hey, those shares of stock that you bought in margin, you got to pay for it.
So you got to source those funds. You have to source your funds.
Yeah, and it's almost like when you're trading, and as you're trading, you apply. So when you go and set up your trading account, or if you do it to a broker, you apply through Fidelity to get the margin account. And it's almost just like a regular credit card. They say, hey, you've been approved for so much money in margin trading. And then that gives you the key, I think, here is just to have the free cash. So, I mean, we got, I got, mortgages, and you got your stuff, but then you accumulate a set amount of cash that you can kind of play these games with, if you will. Because you're not, if you lose, like on GOEV, I'm probably going to lose my $70 that I spent for the call, and I'm cool with it because I expect to make much more than that on some of these other trades. And then this thing is a rotating thing, and I read the analyst reports, I read the Wall Street Journal. If Apple or somebody is coming up with something that's publicly available and it says, hey, they're going to come up with this new thing, and you say, man, let me go look at their stock price. How's it been trading? Well, it's been pretty flat. Well, what happens when this new product or this new thing comes up? What is going to happen to that? And so options trading, there's an aspect of my trading, even sort of what I call day trading, that is not options. Some of it is, I have a couple of ETFs, exchange traded funds, that pay like a monthly dividend. So I don't even mess with those shares. The dividend is great. So every month within my current income, supplemental income, I have certain exchange traded funds. One is a REIT, one is in the financial sector, and actually one is in oil. And every single month it pays, based on the number of shares, it pays a dividend per share. And it's a pretty good income stream of money. And then the excess money that I just have sitting kind of in the cash account of my trading account that's not committed to one of those ones that I'm getting dividends off of, I use that excess cash to facilitate and fund some of this option trading stuff. And every month I try to be disciplined and say, okay, if I'm going to get this amount every month in dividends, I'm going to make sure every month I set aside 30 to 35 to 40% of that in the pile of cash. And so every month you're accumulating that extra 30% and 30%, 30%. And then you say, well, you know what? I think I want to make a quick sort of transaction. And that's what you can do in options trading. Sometimes, like when you talk to people about regular stock trading, they'll be like, man, you can't, go and be trading stocks, buy low and sell high. You can't, that's not necessarily sustainable every day because stock prices don't move that much. So you're not going to be able to usually buy a company's stock and then on Tuesday and then on Friday, it's like, man, I made a couple $100 on that. The options is what gives you that ability to do that, because the value of the option is going to fluctuate with the security. And you can get out. Sometimes I've had an option contract where it's like, you know what? I may have made $12 on it. but then I may make on another one like $116 on it. And if you rack up, if you can get a good steady stream of those every week, I mean, you roll that up into a month, I mean, you can actually make some pretty good supplemental income off of these option transactions. But I mean, that's kind of how it works. You buy the right, so up here is expiration date is right here. So all of these ones that I have in my bullpen right now, something has got to pop off by this date. And then the strike price is the price that the +1 is where I bought the option to buy the contract at this price. So this is $16 is trading at $14.66. $70 is trading right now at $70.03. This one is going to be a loser. Kohl's $28.68. My call price is $32.50. The reason why I got Kohl's, my own personal opinion, Kohl's, and I think I had Ross Stores in here too. I don't know why that would come up. Maybe, I don't know if it did. But we're coming into the holiday season, right? So what happens with retail typically, even with inflation, people are going to go out and spend some money. And so, in my opinion, I'm betting on some of these sort of retail companies, some of them to have enough of a comeback where it clears my call price. I cash out and be like, hey, Merry Christmas, Happy Kwanzaa, whatever y'all doing, and go about it that way. And that's kind of the name of the game. You can use a very small quantity of money. So in this one, like the example here, I probably in this option trade, I think I got maybe $350 in this trade. With $350, I'm controlling potentially $16,500 worth of stock because there's 100 shares in play for these options. But I had to spend but $300.
So Ross, let me ask you about that example right there, because that's where I'm getting stuck on.
Okay.
So round numbers here. You bought the option to buy 100 stock at $500, and then you wrote a contract yourself to somebody else for
$175.
And so say that leaves you on the hook for $300. So what are you wanting to happen? I guess before November 18th, you're $300 in. What are you wanting to happen so that you make money?
I want my target. So when you go, and I didn't go through all this, but when you actually go to set these up, when you go to Fidelity's site or any site and you set up an option trade and you set it up as you're buying one and selling one before and then they'll tell you your net amount, to the example we talked about, 500 minus 200 from what you wrote. So they would tell you at the checkout, you got to come up with 300 bills, homie, in order to do this trade. But it will also tell you in each one of these, they actually have a link of the sort of the break-even point. So in other words, with the PNC example, the break-even point, I don't remember the exact amount, but I think it was around maybe about 167. In other words, I had to spend that $300, right? And so for me to actually break even, it wouldn't just be hitting 165 because I still got to compensate for that $300 that I had to pay. But once you get above, in my example, I'm hoping that price hits about 172, 173. And that'll give me for each one of these, I have like an objective. And so with PNC, I set up an automatic trade. So if the stock price of PNC hits 173, then I have it set up where this particular option will automatically execute the whole damn thing. Okay. And so I will net off of that. I will net, a pretty good amount of money off of that. I mean, it won't be like $1 million, but it, like $300, $400, $500 off of one trade. And all you do
if it hits 173, then
I'm happy.
Then it's you've got it set to buy the 100 at 173.
Yeah. So what you do is when you close these out in total, there's a way to essentially close both of these simultaneously. So there's a tab you hit. And it says close position. So I don't have to individually go and close out the 165 and then individually go and close the 175. I have it set up where it closes the whole thing. And then after it's all closed, in other words, I done made my money because some other person, using the housing example we started with earlier, some other person in Wall Street said, shit, it's worth 173. There's a guy out here. I mean, they don't know me, but there's a whole bunch of there are people who have options to buy it at 165. I want to buy. I want to own the damn stock. I actually want to own PNC stock. So they come to me and say, "Hey, Ross, I'll pay you for that amount of money to do that." And then the value of the 175 option will decrease, but up until a certain point. So once it gets to be above 175, you would still make money. You would make your money, and then you would have to sell at your $10 profit to the next person. So in other words, if you held it, let's say it went to 176, well, you made a really nice chunk of change because it went up $11 on the share. And then the other guy or woman who says, "Hey, now I want to buy it at 175. Hey, okay, cool. Hey, I'll sell you that contract because I've made a really good amount of money. But in my mind, if I can clear on this one, if I can get the stock price to be like maybe about 173, to your point, Doug, I'm actually not greedy. I mean, I'll see one. I mean, there was a day that because I've done this with Apple a couple times, like what I'm doing with PNC. I've done this with Apple. Apple's shares go down. I'll check it out. Say, okay, how much is it going to cost me to purchase at this price? And I'm going to sell one. I'm going to spend this amount of money to get these options going. And then Apple, something will happen and they start cranking back up. And then in your mind as an option trader, you do have that little greedy man up in your head saying, "Man, just hold on for 15 more minutes, man. It's going to keep going. It's going to keep going." And I've had situations where it didn't keep going. And I was like, damn. I tell you one that was interesting. There is a company called Enphase Solar. I did this sort of straddle thing with Enphase Solar. And I was like, man, this is going to be great. It's going to be great. And my wife and I, we were in Hawaii. And at one point I checked my phone and my profit on the option was over $1,000. And I'm thinking, I should probably get out of this because I done made a really good amount of money on just this option. I should get out of it. But I messed around and said, I'm going to just ride it out because I'm going to be greedy. I'm going to try to get up to 1,500. So I'm refreshing my screen and the business closed. And I told my wife, I said, it's going to go up some more. Because, look at what the market, blah, 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 blah. The infrastructure thing is about to pass. But I've got all this stuff in my head. We're about to make even more money. Man, I forgot what happened. Something happened that was whacked. And it went back. It went down to about $49. And I'm sitting, I still had another month though. I still had some time here where I knew it could recover, but I'm like, damn, I don't know if that's going to happen because I don't know if it's got enough runway to recover now. As it turned out, it actually did. It was maybe about 5 business days before my sort of drop dead date, and it hit close to what it was before. And I said, shit, I'm out, deuces. I'm selling it. I'm getting out of this. So, it's one of those things, especially in this market, because there's such wide fluctuations. I could sign in tomorrow morning and I tell you, it happened. What did it happen? So I think it was Ross stores, their department stores. I have an option. I don't know why it didn't show up on them. And on Tuesday, I was plus $100 and something. And I'm like, shit, this inflation report is going to be cool. That's going to come out yesterday. Everything's going to be cool. They say inflation is going to die down. I'm going to make some money. Man, that report came out yesterday that y'all heard. And then you hear the stock market kind of going down. I refreshed and looked at that. My plus $100 and something was minus $79. And I was like, damn, I should have sold it yesterday. But I didn't know the inflation report was going. I thought the inflation report was going to be, because they're in retail. So I'm like, damn, I thought the inflation report was going to be good. Shit, I feel like them two old dudes. Remember that movie? What's that movie? Trading Places? Right. Even though they had real money, I ain't got money like that. I felt like them. I was like, damn, I lost my. Sure. Yes, sir.
Ross, I got a quick question. And this goes back to your housing example. Is there a pathway as the options writer? You use 50,000 and the house goes up to value to 90,000.
Yeah.
Is there a pathway for you or even the secondary person, whoever is buying, to that $40,000 in totality?
Yeah. So sometimes what you can do. So this is what I did. This is what I did on Enphase. So when Enphase recovered, This is what it was like 4 days before the time was going to run out. The option I had gave me the right, I think, if my memory is right, it gave me the right to purchase the shares at $190 per share. The share price got up to $211. So I'm looking like, okay, I got the right to buy 100 shares at $190, and the current market price is $211. I called Fidelity with my crazy ass name, and I said, hey, this is what I want to do. I want to execute the order to purchase these shares now, and then I want to simultaneously sell the damn things at the same time at the market price.
Yeah.
So I called them up, and they said, okay, so you're going to buy them. So the transaction, to your point, was you're going to buy them for a moment in time. You're going to buy 100 shares and, $190 per share. And then you are simultaneous and instantaneously going to turn right back around and flip them, those same shares at $211. So that's $21 per share times 100. So then that was a $2,100, good guy because of doing that. So you have the right even before. So the expiration date is here, but let's just say I wanted to own Kohl's. Like Kohl's is the shit. I think I want to give me some Kohl's. So the stock price goes up to, I don't know, $39 or something. And I got the right to buy it at 32. If I'm a real big believer in Kohl's, and sometimes people who trade options, they like agnostic. Like they don't really care necessarily so much about owning the company. They're just looking to make money off their option. But there are exceptions where he's like, man, I actually want to own these shares. So if Kohl's, in this example right here, if it went up to say $39, I might call Fidelity and say, you know what? I want to buy them bad boys at my contract price of $32.50. Buy them right now. And then I want to simultaneously sell them at the market price of $39. Because maybe I think Kohl's has got runway to even go further. You know what I'm saying? I mean, think about like Amazon and Netflix. And if you go back, if you were to just go and Google Amazon or Netflix and look at their stock history for so many years back, I mean, if you own like 100 shares of Amazon at like 99 or 2000, and you look at the share price right now, or it's ridiculous. So like if you could get in and say, well, I think, I'm just making this up. Like for me, this one might be one I might be interested in owning because it's the lithium ion. The LIT is the ETF for all the companies that are making the technology to make the damn electric cars. So it's like, I don't necessarily want to mess with Tesla because their share price is really high. So it's like, how about I just go and look at a supplier that actually is making the batteries that all those companies are going to need. So this might be one like at 62 right now, but I got a right to buy it up until October at $78. This one I might say, you know what? I actually may want to even own these shares because I think this share price is going to go from 76 to 150, but it ain't going to happen by October 21. But shit, it may happen by April of 2023. So I'm going to just own the share. So it's the same as, we talking about the football examples. It's the same as the option play. Quarterback's got the ball, he run around the corner. He can keep it, he can pass it, or he can pitch it to the running back or somebody else. And so that's what the option, if I think lithium ion batteries is going to be the stuff, I may say, if this option price does, I'm not really as interested in making the option. I'm just going to actually own this share of the stock. And so it just really depends on what you're looking at trying to achieve. But generally speaking, when you think about options, you think about people sticking and moving. They get in, they get the option, the share price goes up if it's a call option, which is what most of what I do is just call option stuff. You can do put options too, because if you sell a put option, or you buy a put option, that person can make money on the stock price going down. And you see that when you I think Elon Musk has made statements in the past about Tesla and day traders sort of short selling it, thinking that the price is going to go down. You can make money off of the price going down. I don't typically play that game as much. I usually go with like the appreciation in the company trying to make money. And like I said, I am shameless. I mean, I'll make $3.12 off an option. Just say, hey, that's the best it's going to get. And then I'll make $2,000 on another one and just close it out. But it's a great way.
It looks like maybe your Kohl's may be a good put option because it looks like they're going down. Would that be an example of if you're going down in the red, that stock is going down, so you're waiting for that to go down to a certain point, then make money off that?
If you were, and so in this one, I'm betting that by November, my bet is that it's actually going to recover beyond my price that I could purchase it at $32.50. And you may be wondering, like, why the hell did you buy it at $32.50? The right to buy at $32.50 when the damn market price is $28.68. The reason why is that if you buy what they call in the money, so you check this one up here. So the GE one, I have the right to buy it right now, Doug, at 70. And it's trading right now at 70.03. So technically, because the market price is 3 cents above the right I have to buy, it's technically what you would call in the money. It's not that much in the money, but it is in the money. This kind of call option that's in the money, as you could imagine, it costs more money. It costs you more money to actually purchase this option because your price that you want to buy it at contractually is really close to the market price. If I come to this one, I say, you know what? I'm willing to go about $4, $3 or $4 higher than the market price, because you know what that does when I'm purchasing this call, it reduces the price that I have to pay for the call. So I'm hoping, but you could do it that way. I mean, you could say, hell, man, I don't think Kohl's is going to be doing nothing. I'm going to write a put option at, I don't know, $29 or $20 or $18. And I'm, just let you can do it either way. I tend to focus more on the companies that I think are actually going to grow. So I'm thinking my bet on all these call options is that each one of these companies, except this one for sure, will actually exceed the amount of the strike price that I have, which means that's the price I can purchase it at and make me some money on the option. And then once I get to that point, especially in this crazy ass market, I've made, mistakes in terms of sometimes being greedy. I think I can make another $50, another $100. I don't do that as much in this market. It's like if I'm pretty solid green and I'm gonna make $300, $400, $500, it'd be like, Ross, don't be greedy. Get out of that. And I'll just sell the whole thing. And then you go on to the next thing. And Fidelity you can go to a screen in Fidelity and they actually have like a whole list of all the trading. Like I'll give you an example. Tesla and Ford today. Ford actually had their article was whale, and a whale is just a person that's got a whole bunch of money. There was some whale option trading on Ford like today, and it was call options, which means that there was somebody who, we don't know who it is, but somebody that's got some major paper, and they call them whales, and they bought a lot of call options on Ford, meaning that person that got that kind of money is thinking Ford is going to go up, in the foreseeable future. Tesla, it was an article about Tesla yesterday, and it said like the same thing. There was somebody that had they bought a shitload of call options, and that basically is indicative that at least that wealthy individual that they call a whale believes it's going to go in that direction. And so everybody has the freedom to use whatever indicators you want. You can read stuff about the whales. A lot of times I think it just starts with understanding the company and understanding their products and understanding their management and, making an assessment based on that. And for me, as long as I know, with these trades, my losses are limited. None of these trades on any one of them individually would I lose more than $400 on any one of them. This one I'm going to lose probably about $70 because it was, just a long call. So I'm going to lose probably about $70 on this one. But all the rest of them, whether it was PNC, any of they're all the amount that the maximum loss is about $400 or less. And, so if you don't make but $2, you still got your $400 back. You have $402. So you ain't necessarily minus anything, but that's the way it works. But it's a tremendous tool if you get involved with it with your broker, or you start playing around with it, because the thing I like about it, per my earlier comment, is that I'm not having to buy, I don't want to spend $16,200 and own PNC stock. That's what I would have to do. If I wanted to say, man, I think PNC stock is going to go up. Well, okay, well, you're going to buy 100 shares? Yeah, okay, well, give me $16,241. I'm like, I don't want to give up $16,000. I want to give you about $300 or $400 to have influence over them 100, but I ain't trying to give you $16,000. And then if the 162 don't hit the 165, shit, I only lost $300 or $400. If I own $16,241 and the stock price go to 150, I'm stuck.
You hurt. You hurting.
I'm hurting.
Hey, Ross.
Yes, sir.
As we begin to wrap up,
Yes, sir.
obviously we're all, I don't believe any of us have ever done any options trading. What would you suggest for like a first time? I guess is there a difference between, so me, I'm sitting here looking at your list. Is the value of the contracts cheaper based upon the stock price? So like if I'm a brand new person, I'm saying, hey, I want to go out here and kind of get my feet wet. Would I look for something that's priced at like 260 because that contract is going to be cheaper to buy? And
I think it's good to start at a lower risk. And to your point, Eric, it's a combination of like the stock price, the expiration date, so for instance, the longer you go out on the date, you know, and so in other words, like with this one, I pushed it all the way to December. Well, that's going to cost me more money as opposed to if I have one that I bought tomorrow, and let's say I have that expiring in November. So it's a combination of the stock price. So this one, which was the inexpensive stock price company, I mean, I spent, like I said, about $71 for the whole shebang. And that's a function of the stock price. And when I bought it, it was probably 2 months. It was, I think, back in July, and the expiration was in September. So the longer the expiration date, the more expensive the security. And then the closer that you want your call price, in other words, that's the trigger that gives you the right to buy, the closer that price is to the current market value is going to have an impact. So for instance, if I'm buying this one and I bought a call at 70 and it's really close to the market price, that's going to be more expensive from a percentage wise than if I buy this one at 32.50 because I'm not in the money on this one at all because the stock market price is 28.68. So if you start with like companies that have like lower share prices, and usually for expiration dates, they recommend about 90 days generally, but that's up to you. Some people may do 30 days. It's cheap. A 30-day expiration is going to be cheaper than a 90-day because if I have the right, or you have the right to buy this house that we talked about earlier, and I got to hold it up for 90 days, that's a long ass time as opposed to 30 days. So I'm like, man, Eric, damn, I got to hold this open for you for 90 days, man. You got to come up with some more cheddar. Yeah. But if you say, well, if it's 30 days, then it'd be something different. But yeah, man, it's a fascinating area, and it's an area where you can, you know, once you get into it, it's almost like a game. You know, it's almost like it's not, I guess it's not gambling, but it is in some way, I guess, a form of gambling. This would be like my equivalent of gambling, I guess, but it's just Wall Street.
You got any other questions from anybody?
No, I don't think so. That was a nice, thorough lesson.
This was one of the better pods because we didn't have to do anything but just sit here and just learn.
Sit back and listen.
Let Ross cook.
Man, I appreciate it. And I have a lot of enthusiasm about it because I'm very passionate about our people in particular becoming obviously more economically independent and financially, you know, and all of that. And so this is a community building thing. I did this when my sons, I'll be real quick, because my sons, when they got to be 16 or 17,
Ross, go ahead and unshare real quick so we can have our screen back.
Yes, sir. Yeah, just when they were 16 or 17, they was like, Dad, you know, I said, you guys need to do a Roth IRA. Like, we need to get it started. And then they came to me and they said, well, what should we invest in, Dad? I said, I'm not going to tell you what to invest in. I said, I'll tell you what I want you to do. Go to the kitchen table and write down the top 20 companies of the stuff that you use. I said, what kind of phone you got? It's an Apple, okay? You got a computer that's a Microsoft. We watch Netflix. Where you go grocery shop? You go to Kroger's. I said, write down the stuff that you do. Write down the stuff that you're using and then ask yourself, are these good companies? Are they going to grow? And then that will give you your list of, man, I want you to come up with 10 companies that you use and that you think that are going to grow. And then what you're going to do, we're going to get on the computer and you're going to find a mutual fund that has those companies in it. Why? Because you've already done the research. You're wearing the damn research. You got a phone in your pocket, you got a computer on your desk. Those are the companies. And so that's kind of how they got started with their mutual funds. And I said, yeah, I could throw you a whole bunch of Warren Buffett books and, you know, a whole bunch of magazines, but you know, you can it's that kind of stuff. Like, hey, this is going to be a promising sector. So I appreciate you guys' time, man. And, I really appreciate the sharing that I do with you brothers.
Once again, we want to thank you for stopping by. And I think we still got 2 more topics for you in the queue. So the listeners.
You'll be back. You'll be back.
Hey, man, I love to talk to you guys. I can't wait till after this Ohio State Michigan game to give. I just want to I want to be on the show after that.
You have to come through for the game, man.
I will, man.
It's an epic time, man.
I will definitely try to do that. I'm gonna get some of these pumpkin beers, and I love you, brothers, and I really appreciate your time. And I'm happy to come on at some future point.
For sure,
right,
man.
brother.
All right, y'all be good, man.
Yeah. Once
Peace,
again. Hops and Stocks, episode 53, signing out.
God bless you, man. Be safe.
Appreciate it.
All right. Peace.
Be a shell of a man if we ever depart. From my heart to I'm riding with you. I'm riding with you.
Podcast is presented by H&S Media Group. We encourage our listeners to drink responsibly. Please note, we are not financial advisors. We do not offer or provide financial advice. Trademark copyrighted by H&S Media Group.